In today's episode, we'll break down two important stories. First, we look at whether people actually use metros, and then we look at how NBFCs fared this quarter. Welcome to the Daily Brief show by Zerodha, where we cut through the noise to help you understand what's actually happening and the most important stories from business and markets. I'm your host Krishna. Today is Thursday, 26th of February. Now, earlier this week on Monday, we spoke about how metros are built. Now, there were a lot of things that we couldn't possibly cover in a single story. Today, we will do the second part of that story. We would highly recommend that you check out that video. Now, to quickly recap, we spoke about why cities need metros in the first place, how they get funded, and why very few metros in the world actually make commercial sense. Governments build them anyway because the alternative, which is letting urban congestion get worse and worse, has its own steep cost. Today, our question takes us beyond the demand planning side of things and into the realm of the operations of a metro. For one, what are the bottlenecks faced by the builders when they start digging the ground? Secondly, actual ridership numbers are often shorter than what occurs in real life. And lastly, an underrated problem in building metros is related to the last mile connectivity, which often spoils the demand planning done. So, let's dive in. The construction of a metro rarely begins immediately after approval and the appointment of a contractor. There's a long wait before a single foundation can be sunk, but it's not without reason. You see, over the past few decades, different agencies and utilities have been laying infrastructure under our roads, but with little coordination between them. There are water and sewage pipes, electricity cables, telecom ducts from a dozen different companies and gas lines. Now, all of this is invisible from above. Even for an elevated metro that runs on concrete pillars above a road, you need to sink pile foundations into the earth at regular intervals along the entire route. Now, these are large concrete columns drilled 25 to 30 meters deep that will eventually hold up the pillars. Now, these pillars in turn hold up the viaduct which the trains run on. However, right where you need to sink a pile, there might be a water main at 1.5 meters or a high tension cable at 3. You cannot drill through any of these. They have to be physically moved first. Now, since it's utilities like water and electricity being moved, this process is called utility shifting. The metro team first has to figure out that the pipe is even there in the first place, which requires a combination of deep radar surveys and digging small test pits by hand to see what's below. Then, if there's a conflict with a water main, the team approaches the municipal water authority and explains what needs to move. The water authority reviews the proposal, raises concerns and suggests modifications. Maybe the new route passes near a sewage line and needs separate clearance from the sanitation department. Now this back and forth takes weeks. Once a route is agreed upon, the water authority has to go through its own internal process. Now naturally, this has to be done without disrupting the flow of water and electricity to households. The pipe cannot simply be switched off while it's being rerouted. You have to build a temporary bypass to keep water flowing, reroute the main, pressure test the new route, and only then dismantle the bypass. Now the pile rig can come back to this spot. But maybe during piling, the team discovers a telecom duct that wasn't on any map. And this whole process starts over. Utility shifting is one of the major reasons metro projects in India run late. However, what this also shows is that often Indian cities don't have accurate maps of what's under their own roads. In well-managed cities like Singapore, every utility authority maintains a precise, constantly updated digital record of everything underground. When any construction project begins, you query this system, get an accurate picture of what's below, and plan accordingly. In Indian cities though, no such unified record exists. Each agency holds its own information, often on paper and often incomplete. Now, not every metro can run above the ground on elevated pillars. In the densest parts of India, the metro has no choice but to go underground. For underground stations, you excavate a large pit from the surface, build the station inside it, and restore the road above. This process is called cut and cover. Now, the tunnels connecting one station to the next are bored using tunnel boring machines or TBMs. These are enormous cylindrical machines with a rotating face covered in hardened steel cutting discs. As the face spins, it grinds through the soil or the rock ahead, and the broken material gets carried backward through the machine and hauled out to the surface. Now, before a TBM drive begins, engineers drill boreholes from the surface at intervals to sample the soil and map what's below. But boreholes are just sample points. The ground between two boreholes can be completely different from what the sample showed. Now, this lack of information is a huge bottleneck for engineers. Now, on a good day in a decent ground, a TBM advances 10 to 15 meters. On a bad day, you might encounter unexpected obstacles like more rock or hitting water under pressure, in which case it barely moves at all. A single tunnel drive of 3 kilometers can take well over a year. Now, this gap between what maps say and what's actually there is a version of the same problem we described with utility shifting. Indian cities simply don't have reliable 3D pictures of what lies beneath them. It's why underground metro construction costs 2 to 3 times more per kilometer than elevated, and why projects with large underground lines often run late. Now, let's say a metro is built and its economics are mapped out. Do people actually use them? In 2023, IIT Delhi and Infravision Foundation published a study that looked at ridership performance across India's metro system. What they found was that most Indian metros are running at just 25 to 30% of their original projections. Delhi, the largest and most mature metro network in the country, is the best performer, and even Delhi is at 47%. A CAG audit found that specific corridors in Delhi's Phase 3 were at just 21%. Mumbai's story is more concerning. The Aqua Line, the city's first underground metro, which cost roughly 14,000 crores to build, averages fewer than 20,000 daily passengers against a projection of 4 lakh. Now, across all 4 of Mumbai's operational metro lines, total daily ridership is under 7 lakh against an aggregate projection of nearly 19 lakh. Now, the city is spending over 90,000 crores building its metro network, but only getting a fraction of the usage those numbers were built around. So, where do these projections come from and why are they so constantly wrong? You see, when a city wants to build a metro, it hires consultants to study travel patterns and build a demand model. The consultants survey people about where they travel, what modes they use, and how long journeys take. From that, they estimate how many trips would shift to the metro if it existed and project this forward 30 years as the city grows. Now, the resulting ridership forecast becomes the financial backbone of the project. Loan sizes, repayment timelines, and government approval all rest on what this model says. Now, as we mentioned in the previous video, everyone involved in producing this model has an incentive for the number to be high. The city government wants a high projection because it makes central government approval easier. The consultants want high numbers to please the client and repeat book them. Nobody in the chain is being rewarded for being conservative. However, even if the demand models were honest, metros in India would still face a problem that no model has properly accounted for. People actually have to get to the station. When someone decides whether to take the metro, they usually think about the entire journey. Getting from home to the station, the ride, then getting from the station to their actual destination. If those first and last legs are painful enough, people may choose to stick to the road even if the metro is faster in the middle. A WRI study that surveyed 7,200 commuters across Delhi, Bangalore and Nagpur found that commuters are only willing to spend about 20 minutes total, including waiting time on the first and last legs combined. Beyond that, most people give up. And that threshold is consistent across income groups and cities. Outside most stations, hitting that threshold is harder than it sounds. Autos that cluster at the exits often quote flat rates that make the last kilometer nearly as expensive as the metro ride itself. Feeder buses run so infrequently that waiting for one alone can push you past that 20-minute limit, and in many places they barely even exist. And even before you get to an auto or a bus, the footpaths outside most stations are broken, encroached upon, or simply don't exist, making even the walk to the station exit harder than it should be. Now, in the end, the metro ends up serving only a narrow slice of commuters for whom the last mile problem is manageable. The same WRI study found that very low-income commuters are often priced out by the combined cost of the fare and the informal modes of transport fill the gap. Meanwhile, high-income commuters don't bother because last-mile options are too unreliable and they'd rather just drive. Now, there's an odd irony running through all of this. Building a metro is one of the hardest things a city can do. India has gotten reasonably good at it. What we haven't gotten right is everything around the metro, the maps of what lies underground, the honest demand models, the feeder buses, the footpaths. These aren't hard, unsolvable engineering problems. There are issues of coordination. And yet, city after city, that's exactly where things fall apart. India keeps building world class infrastructure into a system that isn't ready to use it. Now, in the recent editions, we have spoken extensively about banks, both private and public, and how they performed in the quarter gone by. Now it's time to look at NBFCs. Now, that is unfortunately a trickier job. NBFCs don't fit neatly into one box. Banks, despite their differences, usually operate within a similar structure. NBFCs don't. Some only fund those building a house, some focus their attention on vehicles, some on gold loans or microfinance. Even diversified giants like Bajaj Finance have a range of specialized business lines that command most of their attention. That is to say, one can't treat NBFCs as a uniform category. At a headline level, the sector looks perfectly fine. In fact, it shows healthy, steady growth. Its total assets under management were up around 18% year on year, but this isn't really a single sector. That is why once you break it down by company, you see divergences appear. The traditional growth engines, which is home loans and vehicle finance, are losing momentum. These two together account for more than 40% of total NBFC lending. The slowdown is worth noting. Now that capital instead is moving to very different pockets: loans against property, gold loans, and select parts of unsecured lending. This is visible across the sector, but it's also visible in how individual NBFCs are adjusting their mix. Account for that, and you begin to see a shift in the direction of credit in India. And that's what we're digging into today. We start with housing finance companies or HFCs. For years, HFCs followed a straightforward business model: originate home loans, earn a spread, grow your book. It was a fantastic formula until banks learned how lucrative it could be. Now, banks are structurally better suited for this business. They sit on low cost CASA deposits, the current and saving account money people keep with them. Now, this is the cheapest source of money there is, giving them a huge advantage. With such cheap capital, banks price home loans aggressively, leaving HFCs cornered. They must now choose: either match the rate and sacrifice margins, or keep your prices and lose borrowers. Now, neither option is pretty. Now, as a result, last quarter prime HFC home loans, typically above 20 to 30 lakh, grew just 9% year on year. That barely outpaces the growth in our nominal GDP. They are no longer expanding their footprint, they're barely keeping pace with the economy. So HFCs have shifted gears. Their growth is now coming from riskier products: loan against property, construction finance, and lease rental discounting. The LAP books of prime HFCs, for instance, grew 20% year on year, more than double the rate they grew home loans by. You see something similar in affordable HFCs, which give loans under 20 to 30 lakh rupees. Their home loans grew 18%, but LAP jumped by twice that, 35%. Take Bajaj Housing Finance, one of India's largest listed HFCs. On its investor call, the company's management acknowledged that traditional home loans are lagging and that they had to pivot to non-home loan segments for growth. This too is just a gambit. If it doesn't work out, they'll have to shift to their plan B, which is assignments. Essentially, they might buy out loan pools from other lenders and earn whatever spread they can from there. Now, this marks a change in the economic logic of HFCs. It's usually safe to lend to a salaried employee trying to build a home. Few people gamble with the home they are living in. These other products, meanwhile, are inherently riskier. They tie HFC's fortunes to things like real estate cycles or the cash flows of commercial developers. They do come with better yield, which is why HFCs can still hold their own in these segments. But it fundamentally changes the risk profile of an HFC. Now, vehicle finance last quarter presented a rather counterintuitive story. The growth in vehicle loans was muted, but on the other hand, vehicle financier reported better spreads. That is, their loan books weren't growing but margins were. To understand this, we need to begin with why core growth is sluggish. The GST rationalization that brought down effective tax rates on vehicles was a positive for car sales. Volumes jumped across the board from small passenger cars to large SUVs. But there was a catch. Lower taxes meant lower sticker prices. That is, the ticket size of each loan was smaller. Even if a financier was writing more loans, each loan would be for smaller amount. And so, despite a lot of disbursement activity, their aggregate assets under management were flat. At the same time though, these companies saw their spreads rise mechanically. See, vehicle loans are overwhelmingly given at fixed rates. While the interest rates on home loans, for instance, might float with benchmarks, they stay the same for vehicles. And so, when the RBI cuts rate, as it did through all of last year, your home loans might get cheaper, but not the loans for your car. Now, this was bad news in previous years when rates climbed and NBFC borrowing cost moved up, squeezing vehicle financiers' margins. But in 2025, the cycle flipped. The cost of their funds eased. In fact, several large NBFCs have noted a visible compression in their borrowing costs. Now, on the other side, their assets didn't see the same movement repriced down immediately. Many of the loans on their books were given out when rates were higher. Now, this might come down over time as they start giving cheaper loans after the rate cuts, but when their book is taken together, the blended yield will remain elevated as their old loans continue to offer better high yields. That's why their spreads widened automatically last quarter. This is, however, a temporary tailwind. Soon they'll have captured the benefits of their easing cost of funds as interest rates bottom out. And then competition, especially from banks, will push fresh loan rates lower even though their cost of funds will stay the same. And with that, spreads might start falling again. And so you're increasingly seeing vehicle financiers pivot as well, much like HFCs. For instance, Cholamandalam's SME and home equity books grew 33% and 31% respectively, dwarfing its 17% core vehicle growth. Now, vehicle financiers are turning themselves into a diversified lenders who only happen to have started with vehicle finance. Their rural and semi-urban branch networks are turning into portals from where they can cross-sell higher margin products to their customers. Now, on the surface, the microfinance sector has looked ugly for some time. Its assets under management have been shrinking for a while and its borrower base has also come down. But if you look past the headline decline, there are early signs of stabilization. Last quarter, in fact, MFI disbursements grew by 5% year on year and by 9% over the September quarter. Clearly, the sector isn't dead. It had overheated, but after a phase of deleveraging, the sector seems to be making a cautious return to growth in pockets where it feels confident. Not that everyone's back. Banks are still pulling back hard. Their gross microfinance book fell by a stunning 21% quarter on quarter. The same universal banks that chased MFI yields in good years are now cutting exposure as fast as they can. Specialized MFIs, on the other hand, have been far steadier. Their loan book was almost flat with just 0.5% sequential dip, and their disbursement actually rose 10% quarter on quarter. The result was visible immediately. These institutions gained market share in a single quarter, taking their slice to 42% of the total MFI market. As the generalist banks vacated the space, the specialized with their local teams and collection systems built for microfinance are reclaiming lost ground. But there's something dark plaguing the sector, a mindset shift. As Five-Star Business Finance and others have flagged, there's a behavioral crisis afoot in unsecured microlending. Earlier, most defaults came from inability to pay, like a crop failure or a medical shock or a flood. The borrower wanted to repay, they simply couldn't. We're now seeing something different, an unwillingness to pay. The seeds of this were planted in good times. When microfinance was booming, too many lenders extended unsecured credit to the same borrowers. This allowed them to enter a debt rollover cycle, where they borrowed from one to pay to another. But then regulators tightened rules while lenders too simultaneously pulled back. This rollover game broke, causing mass defaults. And as people saw others default, the social collateral or simply peer pressure in group lending eroded. Others too felt like they had permission to stop paying. Meanwhile, politicians began talking of loan waivers, accelerating their decline. This is why almost every MFI player is now diversifying into secured products, micro LAP, gold loans, and individual lending. The group lending model isn't permanently broken, but repairing credit culture is a slow work. And until that happens, lenders aren't willing to sit through the repair cycle with an all unsecured book. Now, as many other segments come under pressure, gold finance has become the sector's pressure relief valve. The strategic appeal of gold in this environment is obvious. These loans frequently yield over 18%. The collateral, meanwhile, is liquid, mark to market, and sits in your vault. To an NBFC, this means near zero provisioning requirements. That makes gold loan a dream product. The industry's gold AUM grew at staggering rates, but most of this growth is mechanical. As gold prices rise, the permissible loan amount per gram of collateral inflates as well, without the NBFCs requiring a single new customer. Muthoot's core gold business, for instance, soared 50% year on year. Manappuram, burned by its MFI subsidiary, posting a 156 crore loss, pivoted hard back to gold, and in a single quarter, their gold loan book grew 23%. Now, the rush to gold, however, carries its own risk. If gold prices correct sharply, say 15%, the margin calls would cascade through the system. These companies will be forced to auction their collateral just as the market is falling. And as with the rest of the industry, banks, attracted by the same safety and yields, are piling into gold loan too. This is compressing spreads for traditional NBFC gold lenders. Meanwhile, these companies' efforts at diversifying away from gold have largely failed. Manappuram's vehicle finance GNP, for instance, has ballooned to 13.7%. Its MFI arm too is in intensive care. Now, here's a broader picture. Gold loans are seeing incredible growth, but this growth may be hiding the fact that underlying credit demand across the economy is weaker than the headlines suggest. That is, gold is a crutch for loan growth. Microfinance too is showing early signs of a comeback, but the old staples, home loans and vehicle finance, are going through a rough patch despite being such a big part of the sector's identity. Now, this is not a sector moving in one direction. NBFCs are growing in very uneven ways, largely based on how much risk each management team is willing to take. And the difference in risk appetite is exactly why performance is splitting so sharply across companies. Now, coming to the tidbits. IDFC First Bank repaid 583 crore in full to Haryana government departments after a fraud was discovered at its Chandigarh branch, where certain employees allegedly cleared forced payment instructions in collision with external parties. We covered it in our earlier video here. The government has launched the second phase of its national monetization pipeline targeting 16.72 lakh crore over FY26 to FY30 by leasing out operational public assets, roads, railways, ports to private players while retaining ownership and redeploying the proceeds into new infrastructure. The government has launched Bharat Taxi, a cooperative ride-hailing platform where drivers pay 500 rupees to become shareholders and earn a share of profits with zero commissions charged. That's it for this episode. See you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.